Really building a startup is putting yourself in the shoes of your user, your customer. Sometimes it takes 4 months, sometimes it takes a year. It's important to be pragmatic and flexible. Sometimes you get lucky, sometimes you don't. But I still think the reality is if you speak to 10 different venture studios, you'll probably get 10 slightly different answers about what a venture studio is. So Fund 1 is $11 million. And our target is to invest and spend around 500K per startup. We originally put in 1.5 million. I think if you can find the right founders to work with, everything else sort of takes care of itself. So you need talent, you need the founders who are going to build these companies with you, a way of finding interesting problems to solve, unmet needs. And your third ingredient is funding, right? How are you going to actually fund the whole operations? We will give the founder 60% and we will keep 40%. This is a talent game.
Hello, Jeremy. Nice to have you on my podcast about venture studios, startup studios. And we'll talk today about the Platform Studio and your experience, as well as some numbers, challenges, learnings about studios. Can you introduce yourself and how your story with your studio started?
Sure. Well, it's great to be here. Thanks for the invite, Max. I'm happy to tell you a bit about myself and the story of Platform. I guess I have a fairly typical profile for a startup studio founder. I've been a serial entrepreneur myself for many years. I'm almost 50. I started my first company when I was still in high school at 14. I ended up dropping out of college, and I've built a series of startups over a number of decades. I've had some big losses, had some big wins, some points in between the two. And honestly, every time after I'd finished building a startup, I would say to myself, say to my wife, say to my friends and family, I'm never doing that again. But I got to a point in my life where I had to be honest with myself and say, well, I don't know what else to do. I don't know how to do anything else. I really love the 0 to 1 stage of building startups, and Platform in many ways is a vehicle for me to continue to do what I love and do it every day. But I think also I wanted to provide an environment for founders that I wish I had when I was starting out. I think I wanted to help other founders to sort of pay it forward and really provide an environment where founders can get there more easily, have higher rates of success, less stress, more support. So that was a big part of why I started Platform too.
Can you tell what was the year and tell a bit like what is your traction? How many startups have you launched?
Yeah, so the way we work is, and we can go into more of the details later on, but we have a dual entity structure. So we have a fund and then we have a studio, and we raise a fund to build a cohort of companies. So we're currently working on cohort 2022. We are 2 years coming up at the end of the month, 2 years into a 3-year build period for that cohort of startups. We have 13 startups in that cohort. So we've been building them anywhere between 2 years, and some of them, joined more recently into the cohort. So they're, at various points between at the various earlier stages where the most recent one has literally just gone live to companies that are close on a year of monetizing.
Some figures that you can share, because we'll incorporate them in the post and share, like you created, let me remember, 13 companies.
Mm-hmm. That's right.
How many of them raised external funding?
Yeah, so we have, of the 13, we have 5 so far that have raised money from sort of what you would call institutional investors, right? So venture funds. And then we have in total 8 who have raised any kind of money. So of those, so there are 3 that have raised angel rounds so far that haven't been institutional. So that's how we are doing in terms of funding those businesses. It's a tough market out there, but one of the to add a little bit of color there, I mean, one of the things that having a really strong network means that we provide a little bit of a non-level playing field in terms of the funding side of things. I think because of my background and Tim's background, we just have a very strong investor network that really helps drive success in a really, really difficult market.
How much money, total, raised for the portfolio?
Oh, that's a really good question. I don't have that figure immediately to hand, but it will be. It must be getting on for 15 million now, I think, approximately, through a series of rounds. I mean, we've had companies like Mogul in our portfolio that's raised quite a lot of money, and there's a couple of others that have had significant institutional rounds.
So 11 million are for 22 companies or something. Do you plan, so how many companies more you plan to launch using this fund one?
I mean, it really depends. I think we are at a point now where we are extremely choosy on what else we take on. I think this is actually one of the big differentiators between what you would call a venture studio and an accelerator, right? I think with an accelerator, it's very sort of light touch, transient help, whereas we really want to be hands-on, roll up our sleeves, hand-to-hand combat with each founder. And if we take on too much more, we really kind of dilute our ability to do that. So we won't necessarily bring on that much more into this cohort. I think in a difficult market, what we're more likely to do is sort of reserve some of that capital to actually build the ones that we already have in the cohort.
But maybe you have some, I don't know, ratio of how many companies failed when you started them, out of this plan to launch about 22 companies, how actually, what will be the number and what is the percentage of company you closed?
Yeah, I mean, it's very much linked to that stage model. So maybe I'll just kind of revisit that. So, the idea here is, of course, that the more investment you're making, the lower you want the failure rate to be, which is, of course, true in venture generally. So, in our stage 1 process, it's a very light touch. It's just that early engagement. We are very choosy. So I would say I think the numbers are that of people that we seriously engage with, so founders we actually end up having a conversation with and having some basic discussion with, we choose 5% to move forward with, 1 in 20. Mm-hmm. And then when we bring them on, we sign that founder in residence agreement. We work with them for that 6-week process in stage 2. It's essentially 50-50. So 50% we'll say no thank you to, 50% we'll move forward to. Then stage 3 to stage 4, it's about 75%. And then once we go to stage 4, we have the unit economics working. We want to be close to 100% that we get funded, and they should be, because at that point they'll have scalable unit economics, so there'll be evidence it's working. But let's say 95%. So that's sort of the way the funnel works out. So we're killing a lot. We're killing a lot in the early days. I think so far in the cohort we've worked with over 20 founders. So a chunk of them we did not proceed with. For various reasons, but mostly linked to those stage gates.
So 20 founders started this first stage?
20 founders will have started stage 2. So many more founders will have spoken to in stage 1.
400 founders.
Yeah, something like that, yeah.
And what is your focus? Do you focus on specific types of startups?
So we took the deliberate decision in the early days not to be very sector specific. So we have built startups in lots of different sectors. Where we are more focused is in the types of business models that we support. So the name platform is no accident. And if you look at my background, I've had a lot of experience and success with marketplace businesses. So we generally do like to build marketplaces. We do some B2B SaaS as well. But we like marketplaces because although they're hard to start, and obviously anyone who's had any experience in marketplaces will talk about the chicken and egg problem of getting them going. But once they do get going, they just build these great network effects, which make them really, really hard to catch. And most startup opportunities end up being these sort of 2 or 3 horse races over time. So we've developed our and continue to iterate our playbook for building these marketplaces, and we really like them. Beyond that, we probably more defined by what we don't do. I think many venture studios, we try and focus on those things where you can get a product live pretty quickly and you can iterate from there. So anything that is hardware based or sort of very high concept, high design consumer just doesn't work well in a studio environment because you just have such a long period before you can actually start learning anything. So we focus on those that we can generally build an MVP in 6 weeks, get live, and then iterate from there.
Can you elaborate on what is your team and how you engage with entrepreneurs? Mm-hmm. Do you co-found new ventures together with them, or you start alone and then attracting them? And what is typical amount of time from beginning and to the revenue of marketplace-based model?
Yeah, I'm happy to do that. I mean, I think probably the easiest way to explain is to talk a little bit about our process and our stages and the gates between them, because I think you have to sort of match the resources to the process at the end of the day. Our process is I guess not particularly unusual. I'm sure there are many nuances and differences, but we very much modeled it on other venture studios and what we read about, and talking to other venture studio founders, what we learned. So we have a 4-stage process. Stage 1 for us is really about identifying unmet needs, so new problems to solve within a particular area. And we build these theses around themes. So themes might be things like housing or climate or other kind of general investment areas. And then we look for unmet needs or problems to solve. And we do some initial diligence on our own to make sure that we have a kind of solid thesis on the problem. And then as we get comfortable with it, we go out to our network and try and find a founder that we think is a good fit to work on that problem with us. So the end of that process, the stage 1 of our process, is really to have a founder present to us their view of the problem, some basic diligence they've done in terms of competition, the market, likely unit economics. We will decide to not proceed with that founder. If we decide to proceed with that founder, we will sign a founder in residence agreement with them, which is a very simple agreement to begin the process. And then we enter into stage 2 of our process. Stage 2 is really where we do everything we can to de-risk before we start building anything. And it's typically a 6-week process. And it's, to touch on the resourcing, it's very much driven by our design and user research folks on the studio team, who have a really good methodology for how do you validate an opportunity, how do you do user interviews or customer interviews without leading the witness, and to some extent also the financial modeling side. At the end of that 6 weeks process, the founder then presents to us what it is that they want to build more specifically. So they have a much clearer definition of the problem. And often when you go through that process, you sort of, what initially appears to be one problem or one unmet need, as you tease it apart, it actually turns out to be 3 or 4 distinct unmet needs with slightly different sets of potential users and slightly different dynamics. They'll present that to us. They'll present what they want to build in terms of their initial minimum viable product. We actually use the term minimum awesome product or MAP. And we make a kind of go or no-go decision. And our target there is really about 50-50. 50% of the time we'll say yes, 50% of the time we'll say, great, thank you. It doesn't, we don't feel it's quite right. And if we green light at that point, that's when I would say the real work begins. So in stage 3, the beginning of stage 3 is where we build that minimum awesome product. And that's generally a 6-week build to get the first version live. Obviously, that's driven very much by developers, designers that we have on the studio team. We get that product live. We have a very design-driven process to get these products live. And at the end of that 6 weeks, we then sort of hand over most of the driving to the growth team. So the growth team then goes through a series of growth sprints. So a growth sprint is just a month-long period where we're seeing if we can get a heartbeat going with the business. And we use some key metrics early on in that process. So we're looking for really good leading indicators that the market actually wants the product. So we're particularly interested in retention. Sort of depends on the business specifics, but 30-day retention is a great metric for us. We look at NPS. Obviously, we're tracking revenue growth, and we're really just kind of seeing if we can consistently acquire users or customers for the product through a series of growth sprints. And in each growth sprint, we might try different channels, we might try different messages, different audiences, but we're really driving towards proving that the sort of core unit economics work. Can we acquire customers or users in a consistent way at a cost that will work? And that process is somewhat variable. So I would say sometimes it takes 4 months, sometimes it takes a year. It really depends. Sometimes you get lucky, sometimes you don't. So there's quite a lot of variation there. And then really the test of proceeding from stage 3 to stage 4 is, are those unit economics working? Do people love the product enough that they will keep using it and keep telling other people about it? So that's, retention and NPS. And then what is our acquisition cost, and how quickly do we recover that acquisition cost? So we talk a lot about this metric called CAC-D, or CAC doubling time. So how long does it take for a customer to pay you back the cost that you pay to acquire them and the cost of acquiring another customer? Because that's really what defines how quickly you can scale a business. If the CAC-D is relatively short, so less than 12 months, ideally less than 6 months, if the market's big enough, if you keep spending money, you'll get more customers and you'll continue to scale. So if it looks like we're in that zone where the CAC-D is looking good and the retention and the NPS is looking good, we'll then go into stage 4. And stage 4 is really all about doing 2 things in parallel. One is continuing to scale revenue. The other is getting the company seed funded. So going out to our network of investors and getting someone else to, validate by, putting their own money in, putting their own capital at risk to continue to build the business. I'd say, again, it's highly variable, but that whole process from the very beginning to the very end takes, anywhere from 1 year to 2 years, sometimes a bit longer. We have some companies, we have an insurance company that operates in a very highly regulated industry. In those kind of situations, it takes a bit longer because just the basics to even be in business, to get all the licenses are, more involved. But I'd say in general, 1 to 2 years, kind of beginning to end, is what we see.
The role of the studio ends when you get external seed funding.
Yes. I mean, I think this is one of those things, Max, where there's the theory and then there's the reality. So when I first started out, I had a very purist view of how the model should work. So I thought, we would source an unmet need, we would start to build out a solution, and then at a certain point we would go out and we'd find a founder to take it from there. And we've certainly done that, and taken that through to seed funding, and that can work. But I think the reality is somewhat more messy and organic. Sometimes you are looking at a particular area where you think there are interesting opportunities, and you might meet a founder who's already made some progress along that way. Maybe they've already got an MVP live. Maybe they've done a small friends and family round. And what I've learned is it's important to be pragmatic and flexible. And sometimes you want to work out a way to work with a founder in those cases too. So as long as they haven't raised any institutional money in a price round, it's not too late for us. So we've also worked out how to make that model work too, whereas it's a little bit different, less of the kind of purist studio route, but still very much, coming together to use the studio team to help build and scale the company. The other thing that is more organic than I originally thought is the way I described the process, just to keep it simple, was that, we build the company and then we get it to a point at the end where we get it seed funded. Now, that's definitely also true, and that has definitely happened. But one of the other things that we like to do, and we've learned this again just by doing, is we think it's really important to get early validation from investors much earlier in the process, because the ability to keep the company funded through multiple rounds is obviously critical to the model working. So what we've learned to do is actually go out to our network during stage 3 of our process and try and do a small angel round within our immediate network to kind of get it really does actually multiple things. It gives more capital to build the company. It gives validation that we're building something of value to the market more generally. It also gets the founders' feet wet with fundraising and kind of exercises that muscle. And then in some cases, we've also done a pre-seed round during stage 4. Again, if it looks like it's the right time and the economics seem to be working, we can raise money a little bit earlier. So that's another area where I've learned to be fairly flexible. I think it's all about the specifics of where you are in terms of the timing and where you are on the growth path and how the founder's feeling and a number of other issues.
What is your team? Like how many people work in your core team? And what is your support to startups and your help? Is it everything from, I don't know, design, marketing, product development, software engineering, legal?
Yeah, no, absolutely. So I think one of the things about the studio and this sort of also to some extent this remote model is that there's not really a kind of black and white answer to that question, because there are some people who are full-time on the team. Of those people who are full-time on the team, some of them are 100% allocated to one company at a time. Some are shared resources. There's a network of recruiters. There are lawyers and designers and people that we pay hourly rates to. So there's sort of a different kind of relationship depending on the function. But if you think about the core of the value that we are providing as a studio, there's really 4 buckets and therefore 4 leaders in the studio for each of those areas. So one is product development and design. So Lizette is our chief design officer. One is growth. So how do we grow these companies once the product is built? So Brad is our chief growth officer. The next one is talent. So Josh is our VP of talent, so runs everything to do with, finding founders, working with founders, but also then building the teams around those founders. And then the last one is finance, which is me. So those are the 4 kind of main things. And then we have, people, some of whom are full-time, some of whom are contractors in each of those 4 buckets. So the total kind of, FTE, full-time equivalent, I think is 13 on the team. But that someone ignores this sort of, big network of other experts that we have.
Maybe you have something you think is important to talk about for all venture studio founders. I mean that maybe you have some topic in mind that you have some unique experience and we can cover this.
Yeah, I'm not sure I have a unique experience, but I'm certainly happy to sort of share what I think is most important. I do speak to a lot of other venture studio founders and potential founders who reach out, and I think that's great. I mean, I did the same thing before I started. I spoke to a large number of other venture studio folks, both the founders of studios, partners in studios, studio team members, founders who'd been through venture studios, just to kind of learn as much as I could. But I still think the reality is if you speak to 10 different venture studios, you'll probably get 10 slightly different answers about what a venture studio is, and there's always lots of nuance and difference. But I think, if you are listening to this, thinking about to start a venture studio, I think you really have to kind of look at it from the point of view of what are the raw ingredients that you need in order to cook or bake a startup, right? And for me, there are three raw ingredients. You need talent. You need, the founders who are going to build these companies with you. You need a way of finding interesting problems to solve, unmet needs. So, you need that as your second ingredient. And then your third ingredient is funding, right? How are you going to actually, fund the whole operation, the studios and the companies? So I think you've got to just kind of think about where you're going to get those. What is your, what is your unique angle that means founders are going to come to you? How are you going to source these unmet needs and problems? Because it's very hard to do that in a ivory tower, in isolation. You really have to be embedded in a particular problem space or domain or industry to find those problems and understand them well. And then funding, I think, is somewhat more obvious, but a lot of funders of traditional venture are not ever going to invest in a venture studio. So you have to sort of think about, where are you going to find that capital to build? And I would say of those three ingredients, they're all important, but I think the number one thing is talent. I really do think that ultimately this is a talent game. I think if you can find the right founders to work with, everything else sort of takes care of itself. And I think the challenge you have, particularly with venture studio, is there's this idea out there. Now, I may disagree with it, but this is the idea out there that there's already this negative selection problem with venture studios, that the best founders don't feel they need a venture studio. So you're kind of by definition working with people who, are not the best founders. Now, I think there's a lot we could talk about there as to why that's not true, but you do have to contend with that as well. So what is your, pitch to the founder? What is the reason that a founder should come to you and work with you? I think all those things are important. And then the last thing I would say is, if you're thinking about starting a venture studio, just being super realistic about what's involved. It's very hard maybe to understand it, but it really is. If you've been a founder yourself, and obviously most venture studio founders have, it's like being an individual startup founder on steroids, because you're going on that roller coaster ride of early stage startups, but not just for one, but you're doing it in 10, 15, 20 in parallel. And it's an extreme exercise in multitasking. And there are days, there are weeks where it's very hard for me, and sometimes I fail to keep track and keep everything clear in my mind across all these different companies. Remember, what are we talking about here? What is this, problem here? It's just very hard to track all of that. So you have to have, you have to love the multitasking nature and the roller coaster ride.
I had a question, but like you mentioned that maybe you don't doing something differently from others, but maybe you have something, I don't know. What do you think is your unique experience in a venture builder?
I think there's probably, as you're saying, a million little things that we do different. There's probably a lot of things that we do very similarly. I mean, I think there's maybe some things that we take to an extreme. I think the number one thing that comes to mind, first of all, is that I think every venture studio is very data driven, because you are trying to be methodical, but we are sort of extremely data driven. We are capturing pretty much every interaction with every founder, all the coaching notes. We're using all these assessment tools I talked about. We have every founder fill out a weekly update on the tasks that they've done, and the metrics that they're tracking and what's on their mind and their sentiment, how they're feeling. So we just have this enormous data set that we're using to continuously improve and learn and learn problems early. And then I think we touched on this earlier. I mean, sort of hand in hand with that data model, with that very data-driven model, we have this sort of extremist view of building in the open. So the sort of antithesis of stealth mode. So every company, you can go to the platform website, and you can see these weekly updates that they are posting, right? You can see the issues they're struggling, what they delivered, what they're thinking about. It's really kind of a a very different way of thinking about it if you're sort of used to the sort of stealth mode sort of way of thinking about startups.
Is it open to anyone or inside? Wow.
Open to anyone. I mean, there are different parts of the data that are open to different groups of people, but anyone can view the top level update for every company for every week. What has been done? What are they thinking about? What are the milestones they've achieved? That's all sort of public information, and is a big part of sort of building in the open. I think those are the two sort of things that immediately come to mind. I think we talked already about marketplaces. I think we also build a disproportionate number of marketplace businesses. We really like those and really have something of a playbook for them. So those are the things that I would say we really try and sort of think differently about.
Let's start with ideas, because I think it's a bit easier to discuss. So like how to find great ideas to start with. So in my opinion, I think that go into some experts or some founders. So if I would start a studio, I would create a podcast about this field. Let's say it's like, construction or fintech or marketplaces, and I would attract different founders of marketplace businesses to talk about like what problems are there. Of course, not in marketplace, so it's a business model, but you have to go to some financial institutions, attract someone, talk to them, find some problems, attract some advisors from those fields to find. But what is the process looks like in the platform studio?
I think you're absolutely right. You need to spend a lot of time speaking to and listening to experts and other founders and people in the space. Our take on it, and this is really, a product of my background, is just to take a systems thinking view of that and a sort of a marketplace and product view of that. So we built a platform to do that. So we have what we call PlatformOS, which is, you might think of it as kind of like LinkedIn for startups, or you might think of it like almost like GitHub for startups. So we have an online presence. We have about 70,000 people who are signed up to Platform, who talk and discuss around these themes. And if you go to, anyone can sign up. You can go to our website, and you can actually look at all of the unmet needs that other people have posted. You can post unmet needs that you've found, tag them to themes. You can volunteer and sort of virtually put your hand up to say, hey, I'm interested in helping code a solution to this, or helping coach a founder to do this, or funding a startup to do this. So we are trying to encourage that, kind of marketplace of ideas to really ferment on our own platform. And that's actually proven really, really interesting. It's a really interesting way of doing it, of leveraging the kind of wisdom of the crowd. At scale.
You created a marketplace for ideas and for finding problems, actually.
Yeah, I mean, I realized that it's getting very meta, but I think that was also a realization early on that Platform as a venture studio itself is, of course, a marketplace. It's a multi-sided marketplace that's bringing together those ingredients I mentioned. It's making those connections between founders and ideas, between founders and funders. So why not build the sort of infrastructure that does all of that and host that so that we can be the place that happens.
Can you describe like how you launched a marketplace with 70,000 users who share some problems in different niches, probably?
Yeah, so I mean, I think it's it's one of the benefits of being a little older and having done this for a while. So myself and my co-founder Tim Connors, who's been a very successful venture investor for many years, we had between us already about 60,000 connections on LinkedIn. We've been building companies for decades, so we already had a pretty extensive network of founders, of funders, of experts. So we were able to use that as a great foundation for sort of kicking off this online community to do this. And I think, like anything, I mean, again, going back to people thinking about, starting a venture studio, just play to your strengths. We already had that. We had pretty strong and large network we built up over many years. So we were able to do that. And that was a great asset to have.
So you are mainly taking ideas and looking for problems from this platform OS.
It's a combination. Some of them have come from PlatformOS. Some of them have come from just individual conversations with founders. Sometimes, there's something that, one of us on the studio team will spot. I think the most important thing, though, is, one of the things that we very strongly believe is that, stealth mode is basically bullshit. We're sort of extreme in our avoidance of stealth mode. So whatever the original source of the unmet need or problem, the number one thing you need to do is shine light on it and start talking about it. So, we'll start publishing on the website. We'll start talking to experts and other founders that are interested. For every company that emerges from stealth mode and has a success, there are 100 others that emerge from stealth mode to discover that they have built something that no one else actually wants. So, you have to immediately start engaging and hearing other views and opinions. And as you do that, it becomes quite organic in the sense that every conversation you have maybe steers you in a slightly different direction, gives you a new insight. So it again becomes a sort of community effort, a group effort to really uncover truly what the problem is and why now is the time to solve it.
But can you explain how it works? So a person from your network just goes to the website and just like there is a questionnaire. I don't know, what problems do you have?
Yeah, so it literally is that simple. So anyone can sign up. When you sign up, you sort of choose the roles that you're interested in. So you might say, well, I'm interested in being a founder, or you might say, hey, I'm an investor, or you might say I'm a subject matter expert, or any combination of those roles. And then the system, tries to present some kind of structure to it. So our main sort of way of thinking about it is we have themes, as I said, which are things like, climate or housing or areas that we want to focus on. And then any user can then post an unmet need. Now, when you post an unmet need, there's really only two pieces of information that you need to post. One is your description of the unmet need, and the other is a kind of clear view on why now. And that's really important, right? Like, why is now the time to solve this problem, not 5 years ago, not in 5 years' time. And what really drives the why now question is normally one of two things has happened. And sometimes both. I mean, ideally both in a perfect world. So one is some kind of discontinuity or inflection point. So something that's changed in the world that means the sort of continental plates are shifting, which kind of means a gap has opened up for a new entrant. The other kind of thing that can happen is a new enabler. So obviously, the one that everyone has been talking about is, large language models and generative AI. So that is a new enabler that enables something that maybe wasn't possible before. So we're looking for the statement of the problem, we're looking for the why now. And then the community can then come in and they can, follow those unmet needs. So they get updates, they can vote them up, they can put their hand up to say, they want to help solve the unmet need. And they can also post solutions. So people come in and they attach solutions. Now, solutions can be existing solutions they found. So they may come in, you may post your unmet need and someone else may come in and say, hey, here are 3 startups that already solved this pretty well. And they're probably already, too late to catch, in which case maybe that's not a good unmet need to pursue. Or people may come in and propose a new solution to that. So you sort of end up with these set of unmet needs, and each unmet need has a number of potential solutions, and they have a number of people kind of reviewing them and upvoting them. And it becomes just, again, as I said, a way of leveraging the wisdom of the crowd so that the best things kind of float to the top and get our attention.
Is it working evergreen, or like you launch it and say, let's say that today is our day when we post our problems and discuss, or it is like
it's a continuous process. It's kind of an as you said, might say, like evergreen process. One thing that we do at times is we will have a competition around a particular theme, where we will try and drive a particular kind of founder to suggest something. So we've done that a few times, for green home transformation or or another kind of thing that we're interested in, where we just try and drive a particular set of founders to make proposals. But otherwise, it's an ongoing process that's happening all the time.
Let's talk about the last part of attracting investments and then go to founders. So about investments, the easiest way is to bootstrap plus attract some additional funding from your network. How was it in your case? And like you raised the fund from scratch, or you did it, I don't know, you started as a studio and then raised the fund?
Yeah, so we started. We didn't raise the fund from the very beginning. We started with some capital from the founders, and we, really wanted to spend some time to sort of get familiar with the model, to hire, and get the studio team up to speed. So we did that for the first year, and then a year in is when we raised our first fund, and as I mentioned earlier, we're sort of 2 years into that fund.
What is the size? Whatever figures can be shared.
Yeah, I mean, the great thing about the venture studio model is the fund size doesn't need to be that big, because you're focusing on the very early stages. So fund one is $11 million, and our target is to invest and spend around $500K per startup. We have done some direct investments from that fund as well. Sometimes we might meet a company where, for whatever reason, it doesn't work as a studio deal. It's already made too much progress, or there's too many founders, but we really like the founder or founders, and we really want to support the company. So we've made a few direct investments as well. It's not a big use of the capital, but again, it just goes back to what we were discussing earlier about the need to be flexible.
Your experience of fundraising, of course, it's a bit now a different ecosystem or atmosphere to fundraise, but like maybe you have some experience, some tips for future studio founders or current studio founders on fundraising into a studio or into a studio fund.
Yes, I mean, you're right that the world has changed. I think there's sort of actually competing pressures that maybe roughly cancel each other out. So on one hand, yes, the market is obviously very different to how it was in 2020, 21. But at the same time, I think, thanks to people like you and others, the venture studio model is just becoming much more well-known and mainstream. So I think you have kind of less of that, problem in justifying the model. I think, awareness of the model is there, and also the number of successes of companies that have come out of venture studios is growing. So I think it just kind of helps get over that initial barrier. It's very hard to sort of talk about one fundraising experience, because really what you do is at least this is my experience, when you're out trying to find LPs, you meet a variety of different kinds of LPs. I mean, they're all different in many different ways, but if I can kind of think of some archetypes, some LPs, they're really just interested in the returns profile. They're allocating capital to a bunch of different kinds of assets, and they just want to make sure that they are really well diversified. So they don't really care necessarily how the sausage is made. They just want to understand that, your model is, to build these companies, and this will give you this kind of multiple over the life of the studio fund, and they're happy to do that. You meet other LPs who are very interested in the kind of companies that you build, or maybe very interested in the kind of founders you help. And then, yet another kind of potential LP is very interested in the studio model, and some of them have already, invested in other studios, or have been successful tech founders themselves, so really know what early stage startup building is like. So I think you kind of have to understand those different kinds of LPs and their sort of different motivations really, really well in each case. I will say, beyond that, I think it's important to be clear where you are being different and where you're not. And I would encourage people to only be different where they need to be. You're already doing something slightly unusual. If you're an investor if you're a potential LP who's invested in 100 different venture capital funds, all of which have the standard 2 and 20 fee structure, you're already going in potentially with something different as a venture studio. So so then make sure that everything else about your venture studio looks like a standard venture fund in terms of the way the subscription agreement is, constructed, and the way in which the fund is run and everything else, because, you don't want to add too many question marks. You want to just focus on where you're innovating. But again, it's very hard to generalize because every LP is different. Where we focus and where we've had the most success, and I think many venture studios tell the same story, is really with family offices. The majority of our capital comes from family offices, a little bit from institutions who are willing to write smaller checks, and a little bit from high net worth individuals, mostly family offices. And every family office is different. They have a different way of operating. They have a different mandate. They have different things they care about and are interested in. So I think it's just important to kind of understand why the LP is interested potentially in allocating capital to venture studio, and you have to kind of understand they're all at different points on the learning curve. Some of them are brand new. Some of them have looked at lots of different venture studios and really understand it already.
If you can mention, what was the initial capital when you started without a fund for this first year, and what you did with this capital? What was the size of your team?
Yeah, so I think we originally put in 1.5 million, and that really, I think for most studios, the primary cost is simply paying people on the studio team. So really what that money was used to do more than anything was to hire a really great team, build a really great team, and run through the process a couple of times, build a couple of companies, get them sort of through the process to sort of flex the muscles, make sure that we understand the kind of main stages, and that we can source founders, get the kinks out, if you like. So that was the main use of that capital early on.
Can you share what is the structure of this capital from the fund invested into companies? So you also use this capital to pay some salaries for the studio team, but also maybe some amount of this money is going directly to startups or not? What is equity, which gets a studio and which gets the fund?
The basis of the model is this dual entity model, which many people have written about, and there are many great articles written about different studio structures. I think you've written a bit about it as well, Max. So the way the dual entity model works is, we have the fund, which is an LLC that holds the capital from our LPs, and we have the studio, which is a C corp. And essentially, the flow of funds is the majority of the capital in the fund is used to pay the studio to build startups, and then the fund gets equity in those startups in return. So it's essentially a fee for service model between the two. So in a sense, the fund is the studio's customer, and we literally invoice the fund every month for the money spent to build those companies, and then there is an upside in the companies in return. And that is definitely the primary use, the primary model. So the majority of the money is used to pay the studio to do the work, pay the salaries of the studio team. So in a sense, what that means is that the primary contribution to each startup is labor paid for by the fund rather than capital. Now, this is where the nuance comes in, because and the flexibility I was talking about earlier is that's true when we're a true co-founder and we are building the company with a co-founder. So, we will find that co-founder, will work on that idea, that concept within the studio. And then at a certain point, we'll spin out that company, create a new company, and that will continue its journey. And, we are co-founders and we have founder equity in that business, the sort of more pure studio model. But as I said earlier, sometimes you meet a company and you want to do a deal with that company, and that company's already got some traction, and maybe that there's already a legal entity that exists. So in that case, we have to operate a little bit more like a standard fund. So in that case, we will take, let's say we'll put in typically a 500K safe note into the existing startup, and then we'll bill back the studio services to that startup. So from the fund's perspective, it's exactly the same. The money goes from the fund and they get upside in the company. It's just the flow is slightly different. In the first case, it goes from the fund to the studio to pay the salaries of the studio team to do the work in return for the founder common. In the second case, it goes from the fund to the individual startup and then build back to the studio to pay the salaries of the studio. So two different flows, but the fund doesn't see the difference.
Is there a specific amount of equity which a fund takes and a studio takes?
Yeah, so our sort of default deal is that we will give the founder 60% and we will keep 40%. We'll definitely negotiate to a certain extent on that. And it really depends on a number of different factors, like, how many founders there are. Obviously, it's very different if there's more than one founder. It depends on, the founder's track record, a number of other issues. But that's really kind of the way we start. And I think, the reason that that's really important to think about as a potential studio founder is you really got to think about what is your follow-on model, right? Are you going to set yourself up where you can actually invest pro rata and maintain your position in the company, or are you modeling based on getting diluted down at each round? So you really got to think back from the end. What is the ownership that you want at exit, and how does that then drive the returns for your LPs in the fund? So you have to kind of have a reasonable chunk going in because you're going to get diluted down a lot, and you're starting at the very beginning. So you're the most exposed to the dilution over time. So that's where that really comes in. So it's something to think about very carefully.
Are this 40% split between the fund and the studio?
Yes, it's an interesting aspect of the setup. And again, there are lots of great experts out there on these things. But there's a mechanism where the flow of funds on when there's any return is split between, on one hand, it gets paid out obviously to the LPs in the fund, but then it also gets paid to what's called an incentive vehicle. So an incentive vehicle is just another LLC, and it really exists to have this sort of separation between church and state. So the LPs get their money, and then a chunk of the returns go to the incentive vehicle, and then from the incentive vehicle, they're distributed out to studio team members and the owners of Platform as a whole. So as a studio team member, it's sort of if you work for an individual startup, you'd have stock options. For the studio team member, it's kind of the equivalent in a fund model where you've got a percentage of the returns. The specifics of the split between the LPs and the studio team members is not something we talk about publicly. One thing, though, that is important to realize is that the returns for the LPs are preferred. So they will always get their money back first before anyone else gets any distribution from any fund returns.
Thank you, Jeremy. Now let's talk about founders, the most important part of a studio. Many studios I talk to, they say this is our number one priority, to attract as great founders as possible. So how do you do this?
There's two sides of it, right? How do you attract them to begin with, to start, talking to you, and then kind of what are you screening for? What are you filtering for? So I think, it definitely gets easier over time as you build your track record. I think in the early days, we although, as I said, we already had a pretty good network, we didn't have any proof points in terms of venture studio specifically. So we we were really out there, sort of, it's much more like traditional recruitment where we were going out and we were targeting specific people and trying to persuade them to build a particular company with us. And, I'm really grateful to those founders who took the risk early. And, I think back then, whenever you look back at something you've been working on for a while, you kind of maybe almost embarrassed by how amateurish you were then. So, we had some people who were willing to take the plunge with us, I think partly based on, the founders, myself and Tim's track record and do it with us. And, as you then build more and more companies and you start to get those companies through the process and funded, it becomes easier because people see that and, they're able to see those wins. And I think you kind of get more credibility out there in the market. And I think you just need to keep talking about the results that you're showing. So, every week I'm publishing sort of these snippets of data that we're seeing. We're extremely data driven. So we have a huge amount of data that we share in terms of every part of our process. And that really starts to generate inbound interest. So we've been very lucky. We just look back at the data for the past year and we actually, we ended up signing a founder in residence agreement with 1 in 265 applicants. So we're very, very choosy. We're very lucky, feel very blessed to have that because, it's really amazing to just have so much inbound and we really don't need to do a lot of outbound sourcing anymore as we did in the early days. So that's been great. So the second part is like, what are you looking for? And that, to me, is one of the most fascinating things about doing this in Venture Studio. And it's definitely an area where we have continued to refine and develop what we're looking for. It really boils down to, for us, 4 things. And this is an ordered list. This is what's important to me. So number 1 is coachability. Number 2 is grit. Number 3 is empathy or sort of EQ. And number 4 is smarts. And it might be interesting to hear that smarts is actually number 4 rather than number 1, but I'll talk about why. I think coachability, though, is really the interesting thing because it actually is surprising how many people that you meet who, because they have the zeal to be a founder and, they're actually great founders in the sense that they'll just knock down any wall to make their dream a reality. They're just looking for a way of making it happen. And they are seeing you as a venture studio as just another way of making it happen. They could get funding here, they could get funding there, they could get funding from you. And if you're not careful, you can take on those founders and they just won't listen to you. So the whole idea of being a venture studio, having all these resources and this methodology and this process becomes much less valuable because actually they just see you as a way of getting their idea funded and they don't want to listen to the process or follow through on the way of doing it. So the ability to sort of find someone who is willing and able to work collaboratively with the studio team to sort of really understand the best practice that we have to, be coached effectively weekly is really, the most important thing for us. And in saying that, I actually think that there's a really important nuance here, which is I think the part of the discussion around founders for studios is that I don't think that the right founder, the best founder for a venture studio is the same as the best founder for traditional venture. I think it's a slightly different profile. I think it's someone who has a much more nuanced understanding of their own strengths and weaknesses and has a very, very clear view of where they need help. And those people are great for venture studios because we're able to help them. We're able to provide the resources and the teaching and everything that they need to be successful. So that's number 1 for us. Grit is really critical because this is just hard. And one of the main reasons that startups fail is founders give up. They burn out or they just get too frustrated. They can't continue. So an ability to keep going when it's hard, an ability to sort of double down and push harder, just an ability to sort of focus on the here and now. And, I always joke with all my founders, like my line is from Finding Nemo, like just keep swimming, just keep swimming. It really is all just about an ability to keep going when you're getting hit from all sides. So that's critical. And then empathy is super important because, really building a startup is in itself an act of empathy. It's putting yourself in the shoes of your user, your customer, understanding the world from their perspective, and then building a solution that solves their problems. So you have to be really, really good at putting yourself in the shoes of others and understanding and listening very, very carefully. And then smarts is kind of obvious, but I think there's a particular kind of smarts that is needed, which is a sort of scrappy smarts where you're able to deal with this continuous conveyor belt of problems that come to you as a startup founder every single day, triage them really quickly, be able to sort of multitask very effectively, and be able to just always sort of look for the solution that is 20% of the effort but gives you sort of 80% of the result. So there's that sort of smarts, and I think that's different to the smarts of I would call that kind of like generalist, scrappy smarts. It's very different to the smarts of someone who is maybe, very, very studied and methodical in a particular area. So those, that's kind of our rubric. And we use various tools to assess that. We're a big fan of Clifton Strengths as a framework. We have all of our founders or potential founders go through Clifton Strengths. We look at the sort of 5-factor personality model. We recently started using something that I would recommend to many people called the Saboteurs Test from an organization called Positive Intelligence, which has been really sort of transformative for us. So I think there's a lot of good sort of assessments out there as well, which really help give signal on who's going to be a great founder.
When you attract founders for the first stage to try to find problems for future startup, do you pay them some type of, I don't know, salary or stipend or something? Or when you start to invite them to your team and say that, okay, let's work full time with us together?
We don't pay during that stage one, and that stage one is somewhat light, right? It's something that people will do just for a few evenings and weekends. It's really just assembling a basic thesis on what is the problem, why now, some basic competitive diligence. We have a recommended format and sort of a set of data we're looking for. If we decide to work with them and we sign the founder in residence agreement, then absolutely we pay them. So we pay them a salary for their time. And then through that 6-week period for stage 2, we're paying them that salary. And then if we decide to move ahead with them, we'll continue to pay them, a salary up until the point at which they're able to, essentially pay themselves by raising money into that startup and kind of having their own payroll. And I think that's really important because it's actually one of the reasons that you have sort of a challenge as someone who is maybe an underrepresented founder, is kind of out of network. Is there are many people who are potentially great founders but just don't have the ability to go without income. So for us, it's a sort of a way of leveling the playing field, is that if you work with us, we'll pay you to work with us, so that you can continue to focus on the business as opposed to worrying about income.
Do you attract only one founder, or usually these are like 2 co-founders or more?
So our primary, like many of the things you've probably picked up the theme here, is there's a theory and then there's the practice. So our model works best for solo founders, and that's where we focus. And the reason for that, again, primarily comes back to the ownership. If we were to take 40% and there's 2 co-founders, we end up being the biggest shareholder, which doesn't really feel very good, and that means we have to push down what we own, which makes our return modeling more difficult. So we've definitely bent that rule. There are cases where we've worked with more than one co-founder, but generally we try and work with solo co-founders. And really, we try and work with solo co-founders who have a really strong and passionate approach to the problem that they want to solve and the kind of mission behind the problem that they're solving. And generally, they will be non-technical founders, because one of the things that we have on the studio team is a whole set of product designers and engineers and other people who can build solutions. And we can teach them how to be, good product managers and how to kind of think about product market fit. So we'll generally focus more on what are they passionate about? What is the mission that they're on over, their ability necessarily to build. And that's proven pretty successful for us.
What is salary when you started paying then on stage 2? Like what is it?
Yeah, so I have this sort of rubric that I use to think about this. So we want to try and balance two things. So on one hand, we want the founder to be focused on the business, and we want the founder to not be distracted by worries about being able to pay rent and and obviously eat and the basics. But at the same time, we want the primary motivation of a founder to build value in the company, right? We don't want them to be like too comfortable and feel like this is just a salary position and there's nothing at stake. So what we do is we look at what is the prevailing wage or salary for an early stage founder and where they live, because we work with founders from all over the place, and then we take 50% of that amount, and that's sort of our starting point to talk about what we'll pay them during stage 2. And then as they proceed further into the process, we normally adjust that a little bit to kind of reflect the progress that they've made. And then obviously once they spin out the company and raise their seed round, it's between them and their board what they pay themselves. So it's sort of trying to keep the incentives in line with kind of what we want them to do.
If you can give some, idea or range, something like, 8 to 12,000 a month, is it something?
Yeah, I mean, I think if you look at the US where we mostly focus, an early stage startup CEO might be paid $150,000 a year, US dollars. So we would pay for that 6-week period $75,000 a year. Now, of course, they're only being paid for 6 weeks, so the fact that it's $75,000 a year is kind of, but that's the general way that the math will work. Now, certain locations, if the founder's in New York City, it's going to be a little different to if they're in Florida, to if they're in Arizona. It really kind of depends where they are.
How do you think about AI and will it influence marketplace businesses? Because I thought that, for example, there might be many tools, vertical AI tools, but I think that usually vertical businesses, they win generalist businesses when there are network effects. But I think that if you can, for example, train yourself for an interview with some AI bot, so like ChatGPT will win this because they recently introduced the AI conversation bot or something like this with voice messages. But what do you think? Like how AI will change the way marketplaces are created? And do you agree with the idea that AI kills network effects? Because you don't need humans or people to go and talk to someone if you have AI bots.
Yeah, I don't think that it kills the network effect. I think it probably accelerates some of them, and it probably makes some less powerful. I think there's some nuance. I think it depends on the kind of marketplace. So I think that obviously marketplaces are different. Typically what you're doing in a marketplace is you've got some balance of parts of the marketplace and the interaction between supply and demand that are entirely driven by products and automated, and some that are driven by sort of human interaction, either between the two sides or also between the two sides and the product, or people who are working inside the startup. So I think there's obviously sort of content creation, there's chat and messaging between participants in the marketplace, all of which can be accelerated and kind of automated. So I think if your marketplace is reliant on content, then I think you're right that content creation has suddenly become, one or two or three orders of magnitude cheaper and easier to do. So that becomes, less powerful as a network effect. But I think there are other network effects that are much harder to reproduce and are still very strong. So I'll give you an example from our portfolio. So we have a company that everyone can read about because we build on the open, called Party Please, which is a marketplace for parties. So in this marketplace, there's supply and demand. So supply is the party vendors, so people who make cakes or deliver balloons, or I was reading about donut walls recently, which is an amazing thing that everyone should have at every party. And yes, there is content creation, and we're already using AI in Party Please. So one of the things that you, as the person who wants to have a party host, will want to do is look at different themes of different parties, and we're using image generation to generate different kind of themes and party images that people can choose from. So that part has become way easier to do at scale. But when it comes down to the actual party happening and human beings having the party, there's rating that happens after that, right? So every host gets to rate every party vendor, and every party vendor gets to rate every host, and also every other vendor that they work with. And that is a big part of what drives the network effect, right? That's the classic thing of how does the 1,000th user benefit from the 999 that have gone before them? Well, the marketplace, the network effects being built there are really a factor in some way of all of those reviews that are happening between all the participants. And these are real parties happening between human beings that can't really be reproduced by a large language model in any kind of meaningful way. So I think the answer is is a kind of classic it depends, right? Depends what you mean. So content creation, sure, but actual interaction between the participants in the marketplace, not necessarily.
You work remotely, or you have some office for the main team?
Yeah, no, that is maybe something I should have talked about when I talked about what makes us different. I don't know how different it actually is, but because we started during the pandemic, and in 2020, and really we had to kind of learn to deal with this. We built everything around a pure remote model, and we have not changed that. So in fact, I have not met the majority of founders in person. Now, we're going to change that. We're actually planning a in-person event next year, but that will be the first time that many of us have met in person. And that actually is very strongly linked to this sort of hyper focus on data, because in that all remote world, there is no accidental communication. There's no picking up on something you hear in passing on the corridor, or someone dropping in to your desk or in the kitchen or whatever. And there's no sort of picking up of body language to see if someone is worn out or tired or happy when they come into the office. All of the interaction has to be deliberate. So there's we try and compensate for that with this very strong focus on data, and not just data around metrics, but data around the softer side of things. Tracking people's sentiment. How are they feeling? Are they feeling stressed? Are they feeling lonely? Are they feeling like they're getting the help they need over time, so that we can kind of have that sense that we just don't get from working with them through Zoom.
Okay, great, Jeremy. Maybe you want to share something which I didn't ask you. So, but you want to share something additional? I don't know. Your biggest mistake?
Oh, biggest mistake. I think the biggest mistakes come from the founder side, which, as I said, is the most important ingredient. I think some of the biggest mistakes really relate to not selecting for the right things. I think there are people who, as I said, who are not interested in being coached. And I think, you can't coach someone who doesn't want to be coached. So I think, we've made lots of mistakes in lots of different areas along the way. But I think the people side is always the most dangerous area to make mistakes. And we've definitely made some mistakes in the early days there. I think I think also just being realistic about where you can help and where you can't help, I think, is also something for every studio founder to think about. I think some of the mistakes also, come from that wishful thinking of where you think you can move the needle and where you can't.
Great. Thank you, Jeremy, for your story of the Platform Studio.
Thanks, Max. I really enjoyed it.